Good afternoon, everyone, and welcome to today's panel on how firms are turning ESG metrics into financial returns. My name is Martina Chow, and I am a senior analyst and a research lead at Economist Impact Sustainability and Climate Policy team, and I'm going to be your moderator for today. So before I introduce the fantastic panel of speakers that we have today, I just want to remind you all to make use of Slido, ask questions. I'll reserve some time at the end to answer the ones that come up, but I'll also kind of take them as they come along where relevant. So before we kick off, I just want to sort of set the scene. I think it's very unlikely that any of you in this room have not heard of ESG. In fact, I think in the last 2 days, we've had so many panels looking at ESG in a number of different ways. It's become a topic that maybe was relevant to just a few individuals a handful of years ago to now something that's mainstream at the forefront of a lot of business strategies and global conversations. But I think as these factors become more ubiquitous, so too do the criticisms and concerns around that. And we've really seen that come to the fore in recent years. We know that the need to act on climate change becomes more and more urgent every day, but we're also operating in an increasingly difficult economic climate, right? So in this context, how does ESG continue to make financial sense? We at Economist Impact actually conducted a study recently that looks at this backlash. It's titled Pushing Back and Moving Forward. And we look at how this backlash has evolved and what corporations and governments can do in response to it. So I'm really excited today to actually welcome the fantastic selection of people that we have here today to discuss some of these issues. So first, Stephen Daintith, Chief Financial Officer at Ocado. Then Anna Palage, Vice President for Sustainability and ESG at PepsiCo. Sorry, because it's a different order. Rob Colmer, Head of Sustainability at Aston Martin Lagoda. Freddie Duffield, Global Head of Corporate Affairs at Oritain. And Paul Volpe at the end, Senior Vice President of Growth for Workiva. So maybe just to sort of kick us off, Anna, I want to ask you just to reflect on how you feel sort of just ESG in general has evolved in recent years and how you've seen that conversation kind of come through recently.
Absolutely. So at PepsiCo, I lead up our ESG reporting work and strategic investments. And the pendulum has been swinging, but it's very clear that at PepsiCo, we know where the pendulum's going to land, that sustainability and ESG is intrinsically integrated into our business and the long-term success of our business via the nature of our business. So we have a large part of our portfolio is food. So over 55% of our portfolio is rooted, if you will, in soil health and making sure that we're growing crops that we put into our products regeneratively, not just sustainably. We know that the customer is now purchasing more from a purpose standpoint and incorporating that into how they think about the products they purchase. Our customers, including right here that we have some on stage with us, are also, as they think about their sustainability strategy, we're part of it and are asking us questions or for partnerships. We've heard a lot, even earlier on the panels, of the different audiences from an employee standpoint. Millennials are going to be much more part of the biggest part of organizations in the future, and ultimately they care a lot about sustainability. And then finally, it just makes business sense to make sure that we're resilient from a food and beverage standpoint and open ourselves up to pools of capital. So we know that sustainability is integrated into what we do and how we do it, and that's why we launched PepsiCo Positive, our strategic end-to-end transformation with sustainability and human capital, so planet and people at the center of how we do and what we'll do to grow and transform our business.
Great. No, thanks. And I want to pick up on some of those points that you mentioned on sort of your different audiences, your partners. But before that, I kind of do want to address the question of the backlash that ESG has probably faced in recent years. So, Paul, I wonder if you have any thoughts on some of this recent backlash. What do you think has happened? What do you think it's a reaction to? Yep. Do you foresee this shaping coming trends going forward?
So Workiva has served large multinationals. We basically help large multinationals prepare all their financial disclosures and really bring consistency and assurance to those disclosures. All of our customers, when we look at, we did a study recently with PwC that looked at public companies, and a good 95% of them since the SEC, if I were to use that as an example, 95% of the companies that once the SEC made a proposal, 95% of them said they've been more invested in ESG in that direction, and 70% of them have said, regardless of that being finalized, they're going to move forward. So it is, when we got started helping build transparency around financial data, the uptick from really 10 years ago was starting with companies like PepsiCo that were early on in trying to drive financial decisions and sustainability decisions and seeing how they were strategically intertwined. That is becoming the mainstream, and it's not just fringe companies that are thinking about this anymore. It's all of them, and regardless of whether it becomes a political tool for certain parties or certain participants, our customers, the next generation investors, they want this. It's the future.
Right. And sort of building on your point on how financial decisions, ESG decisions are becoming increasingly intertwined, Stephen, I wonder, in light of all this, I guess the big question is, how do you think ESG continues to make financial sense? I don't want to use the exact same words as the panel conversation, but...
Sure. Well, I'm just going to build a little bit on that previous answer as well to begin with. So the way of thinking about this is in terms of the backlash. Over the last 10 years or so, we have pretty healthy financial markets. We've had low interest rates, low inflation, access to capital has been good. That capital has allowed investment. And in a world where things are good and people are growing because they're putting capital in and revenues are growing and profits are growing, shareholders, investors, those pension fund managers are all happy. And when they're happy with the financial returns, ESG is sort of like, we'd like to do ESG as well, please, because they can afford to ask that because they're generating profits. The backlash that's come recently is because companies are now, many companies are in a challenge space. For those reasons that I just described, you've got high interest rates, capital is difficult to access, you've got high inflation. So what happens is that ESG becomes less of a priority and the shareholders are saying, we want profits, we want cash flows, we want dividends. The demand is still there for ESG and all the stuff that we're doing, but it's less important than it was at this point in time. The priorities have changed. And then in respect to the backlash, in terms of the disclosure requirements and the reporting requirements that are taking place as well, corporates are feeling under more pressure, having to build new teams, collect data they've never collected. And again, this is a new space for corporates. We all know it's important that we do it and get stuck in and get involved, but it's a different world from the one that we've been used to, if that makes sense.
Yeah. No, it makes complete sense.
And then the main question that you asked me is...
Why do you think, despite all this, it keeps making financial sense?
So I think, in my mind, where it makes sense is where your ESG goals are linked with your strategic goals themselves. So if I think about Ocado, we've got 3 key goals, which are 1, to reduce carbon emissions through our operating platform. We run automated warehouses around the world that are basically the equivalent of 20, 30, 40 supermarkets in one space delivering to the home. Now, what that means is you don't have those 20, 30, 40 supermarkets and all the heating and transport backwards and forwards that goes into those. You have 1, nor do you have all the shoppers around the world getting in their car every Saturday morning, driving to their supermarket and driving back. That's a carbon emission-friendly operating model. The next thing we are focused on is food waste. Our food waste, because we have 50,000 SKUs, stock items of groceries in each warehouse. And what we do is we keep our stock levels at level, because we can have visibility of the orders. If you're an Ocado customer, you're placing your order, we get a really good visibility into your regular shopping basket. So we stock up on the right items at the right time in the right locations. So our food waste is about 1% of typical grocery food waste. So food waste is a lot lower. Finally, this is something that probably isn't well known about Ocado. We employ over 3,000 technology people, software and hardware, in the UK and in parts of Eastern Europe as well. So recruiting and attracting and developing technology talent is our 3rd strategic goal and linked to ESG. So you can see that these 3 things, technology talent, skill sets of the future, food waste, carbon emissions, all linked in with our strategic goals that will deliver profits, and at the same time, our ESG goals as well. I think that's where it can make sense.
Yeah. No, that's great. And I think a few of you have kind of alluded to this idea of reputational risk and the kind of consequences maybe associated with not incorporating these things, whether it be about recruiting talent, working with your partners, collaborating. So Freddie, what role do you think reputational risks play in all of this? Do you see that becoming a bigger determinant of business performance and sort of financial returns?
Well, I think so, and I think there's a couple of points to make here. I mean, we've talked a little bit about reputational risk. Is also about operational risk as well. So for me, reputational risk, and let's just take an example in the last 24 hours, many of you will have seen in the media the idea of another meat scandal, where things that you think you're buying are not actually what you're buying. And so here we are again, many years after the horse meat scandal, and what Oritain is particularly focused on, and the clients and the governments we work with, is on being able to help companies across the world understand their supply chain so that then you at least have a couple of things. The first is you have transparency wherever it's possible. You have robustness wherever probable. And finally, you have something that's completely independent, so you can legitimately say when there is a problem, we know what the problem is. We've got an independent person who knows how to help us. And finally, we can then stand up and talk about those things. We've mentioned, as Stephen said, about food, but that also happens increasingly around other factors in ESG. And I think the final point to round the answer off is that if we are serious about ESG, it shouldn't always be seen, even in this cultural and economic environment where we have a legal war in Ukraine, energy, inflation. There is a positive case to be made for ESG, and it has a tangible impact on the balance sheet in a positive way if you can do so. So for me, the idea of ESG being something that we have to do, or it's something that we need to be able to get on it, I don't think is accurate. I think it genuinely is something that we need to be able to make a positive case for, and that's why when we work with clients at Oritain, which we do across a number of sectors, they say it really helps us to be able to verify our supply chains right the way through from that lovely cotton shirt that I'm currently wearing today, all the way through back to the original cotton. So for me, the message is that ESG can have a really positive impact on the financial metrics.
Yeah. And before we dive into some of the specificities around supply chains, I want to ask you, Rob, I think we've been talking a lot about how can ESG make financial sense, and it's almost as if we're talking about them as two sides of a different coin. And what do you think of this idea of marrying the two concepts? Do you think slowly this conversation about the profitability, the sort of financial returns associated with ESG might start to become more arbitrary as people start to maybe incorporate them a little bit more into their business operations?
Yeah, absolutely. So two sides of the same coin is exactly how I look at it. Strong ESG performance is going to deliver strong financial returns. Mm-hmm. And I was sharing with a few folks yesterday how excited I am every month when our energy bill comes down and the progress that we're making. So it's less pressure on natural resources, lower CO2 emissions, and then that follows through across all areas of the business. So whether it's water bills, the use of kind of innovative materials and so on, these are all really positive ways in which we can impact the bottom line. And that then gives us significant traction with CEO, CFO, other leaders and the board, and they really want to get behind what we're doing because they can see that the company's benefiting.
Yeah.
Maybe on this point, I can chime in, because one of the things, like in terms of, can business value be driven along with sustainability, and are they married, or how do you incorporate those? Mm-hmm. One of the things that we're making sure as we drive our transformation, PepsiCo Positive, at such a large company as ours with such a scale, we're actually making sure that we're incorporating sustainability at the front and center and heart of our financial decisions, not having it something separate at the side. And maybe I could give a couple examples of doing that, as well as bringing more of a financial lens to our sustainability agenda, and then also using financing as a lever. But I'll start with just kind of the first one, because I know we have a lot to cover on the panel. But ultimately, if you think about how the company spends money, making sure that sustainability has been a consideration in all those decisions that you're making. So from a capital process, right, we're a very large company, and we have a lot of money that we spend on equipment or other things that we want to build. And we've taken the capital process and really we've in the past had sustainability criteria, but in the last couple of years, we've really elevated that. How much of the capital approval request, we actually have a separate section of PEPSCO positive that's front and center within the forms that need to be submitted. We have a cost of calculator that helps evaluate the non-financial costs of what you're building. And then ultimately, we also have our CSO, our Corporate Sustainability Officer, as a signatory on our corporate and stemming that down and trickling that down to markets and BU levels of approvals and making sure that, if you're building something, it's going to be around for a very long time. So ultimately, you don't want, how you're driving efficiency too is thinking about that consideration up front, because if you're not incorporating those parameters on efficiency on, from a climate perspective or water perspective or other ways, then it's going to be a lot harder to then go and make the argument to rebuild something, right, and not then infuse criteria. Or if you're not integrated right at this very start of those decisions, then ultimately you're always playing catch up. And you're never going to really transform the way you need to if you're not at the table right at the start of that decision making. And we're doing very similar on our merger and acquisition works and other parts, but I'll just keep it at that because I know that there's a lot of content. So
No. And I'd love to come back to that point on how you might actually be able to incentivize better practices with your partners, with your suppliers. But I'd love to kind of invite you, Rob, to maybe comment on that, because I would imagine you also have a pretty extensive supply chain to think about. And then I know that you've spoken a little bit about the importance of a rigorous materiality process. Mm-hmm. So I wonder if maybe you can kind of speak to that and maybe its importance in terms of how you might be able to incorporate factors into your operations.
Yeah, I mean, a lot of the stuff that Anna's just mentioned actually, is best practice really in terms of having the sustainability criteria as a screening factor throughout all your business and processes, whether that's CapEx or procurement. What we're looking to do is try and partner with our supply chain and start to flow in more and more principles around where we're sourcing, how we're sourcing, and how the whole supply chain operates as well. If we're bringing materials in, have we got opportunities to reduce packaging, to reduce CO2 emissions? Looking in particular, so Aston Martin, a British company, we build all our cars here in the UK. How can we source locally as well and work with our suppliers to make progress in this area? Yeah.
I wonder if maybe Stephen, you also want to jump in, because again, it's all the three of you kind of have these probably common issues or overlapping issues when it comes to considering these things.
Yeah, no, supply chain is really interesting. I think where ESG has been really valuable for us is, and I'll be frank here, that we've learned more about our supply chain as a consequence of thinking about ESG, stuff that we didn't know. Because what you tend to have when you're running a corporate is you're buying from a supplier who might be, let's say, based in Mexico, and you think, okay, but I'm buying from a Mexican supplier. But what you don't do is you don't think, well, where do they get all their stuff from? And being frank, so ESG causes you to think harder about your supply chain, critical components, but also source of destination as well of those. And then how are they, for example, if they're minerals, how are they extracting those minerals? Yeah. We don't know the answers yet, but we're on the case.
Yeah. And Paul, I want to ask you kind of, because I know that you work in the realm of technology, how does that intersect here, and how might that help sort of facilitate or support on certain processes?
Well, it's interesting. Stephen was talking just about the economics of this have to work out, and investors are going to expect a certain amount of return, and how much, to your point, how much leeway they're going to give you in a time when things are a little leaner. One of the for us, what we're seeing really progressive companies looking at all these voluntary standards. They've got so many things they're trying to report against. The idea of having, knowing what good looks like, to know what questions to ask, to know what impacts your company and the environment, like those are what all these voluntary standards are giving people. There are not enough sustainability people out there. In fact, early on when we talked to our sustainability customers, they're almost they're overworked. They have a lot more they're trying to accomplish, and they're doing it from the outside. Yeah. And now all of a sudden, ESG is exploding, and the demand for their talents, their skills, their knowledge is going everywhere. And there's a little bit of a comment like, "Hey, you didn't pay attention to us before when it was the right thing to do. Now you care because investors sort of care." Well, the only way to start, instead of making sustainability people part of finance or incorporate the controls, the automation, or the controls and the automation, is to start bringing those finance teams a little bit more into sustainability, bringing those principles to them. That's what technology can do. So It is about scaling that knowledge, automation, reducing the cost of compliance. And we do believe, and we see this from our customers, when we start to have what good looks like from some of the voluntary, but more governments giving guidance, those that really want to participate in there and make improvement in the efficiency from technology can come when we have something to shoot for. That's what we're really doing for our customers, bringing those sustainability, finance, and risk teams together and automating so that the cost doesn't become incredibly high.
Yeah. And I want to come back to some of the points you've raised as well on sort of disclosure standards, because I know that's a whole different sort of beast to tackle. But before we do that, I do want to sort of stick onto the topic of supply chains and ask you, Freddie, because I know that you work with data science and forensics. So in that context, how does sort of traceability play a role here? What's the importance of that when thinking about ESG across your supply chains?
Thank you. So I think for the clients we work with, we find that very similar to what Paul's just mentioned, which is that clients come to us saying, we really want to understand it truly from a completely independent perspective, and we know that your forensic science and your data allows us to do that across a number of different verticals. We've got a number of pieces, and I think for us, really the most important point is understanding if you have a problem, don't hide it. Don't try and hope it will all go away, because it won't. And the simple reality is that governments increasingly are taking a more muscular approach to ESG. We've seen in the United States, we're seeing in the European Union and in member states as well, that they care and they expect companies to care as well. And I think, to build on Anna's point earlier about consumers, Gen Z and millennials really do care. So when we have conversations with them, they say, look, please can you understand our supply chain with us and have multi-year partnerships, not moments in time, not a tick in the box, nothing to greenwash. This is something that is a tangible proof point that says we need to be able to work on this over a number of years because we know it matters to our competitors who have it, our regulators who insist on it, and increasingly our investors who are saying if you don't have a robust supply chain, we're not going to touch you. I mean, just to give you one stat, if you look at the recent reports from PwC that assets under management related to ESG integrated funds, in 2021, there are about 18 trillion. Within 2026, they're going to be 33 trillion. So I think that's just a very tangible proof point that says you need to be able to look at this, and the supply chain is one element of ESG.
No, absolutely. And I want to come back to you, Anna, just before we touch on this point of standards, disclosures, do you have any thoughts on sort of best practice? Because one of the challenges as you work with many partners, as you work with different sort of stakeholders is, keeping your suppliers in check or incentivizing your suppliers to adhere to the standards maybe that you set. So do you have any sort of thoughts or best practices on how you might be able to incentivize or even reward sort of compliance and strong performance on that front?
Yeah, absolutely. As I was saying earlier, that we are a food and beverage company with over half of our portfolio on the food side, and ultimately, one of the three pillars of our PepsiCo Positive program is around positive agriculture. Also have positive supply chain, positive value chain, and positive choices. And so we work with a number of different suppliers. Stephen, what you said earlier, resonates in terms of, it's not just the initial supplier, but the whole value chain. And we've been doing sustainable farming programs for a while now. We have over 40,000 farmers that we're working with from a sustainable farming program, and a large footprint of farmers that we source from actually directly, on whether it be potatoes or whole corn or oats, that we're directly working with on progress and incentivizing them to be driving, and not only now to sustainable farming practices, but also to regenerative practice. So we have a goal to regenerative farm 7 million, the crops that we source from 7 million acres, which you could think about is huge. So how do we go about help financing that and drive incentives on that or other parts of our value chain? So for example, we last week announced a $216 million investment in 3 key farmer implementation groups in the U.S. to really drive regenerative practices within those programs. And last year, we were able to actually have a matching grant that we applied for from the USDA. So ultimately, that's a way that we're actually just doing private funding, but the public-private partnership to really give the transition the boost it needs from a financial sense. And all that grant money is not going to PepsiCo, it's going to the farmers and those implementers to actually drive that transition that we're looking for. Maybe just one other quick example, because it's like our value chain is so big. So when you think about not only directly suppliers, but within our value chain and decarbonizing, we have other suppliers. What we've done is one example of getting better payment terms to suppliers. We've done a program in Brazil within the last 6 months where we're giving better payment terms to suppliers that hit ESG criteria. And ultimately, if you think about that, right, you're really taking and not only driving your programs forward, but also incentivizing your whole value chain to do that. And by then looking at outside capital, you're then really trying to drive that transformation at scale that we're doing with PepsiCo Positive.
Great. And I know you earlier mentioned this question of how disclosures are increasingly a new space. There's a lot more pressure to do so. So what do you think, and I invite you, Rob, as well to chime in here, what do you think is the right level of disclosure? And how do you think that companies might actually be able to start going beyond what's mandated and sort of start kind of pushing the boundaries there?
Okay, so a few things on this one. I don't know how many of you were here for that last session, but I thought what that chap said at the very end was like spot on. Make it accessible, the data, to the reader. Yeah. So much that's in an annual report of a company is a bit gobbledygook, sort of technical jargon, and ESG, I think, is in danger of falling into that trap. I think the trick is to turn it into something that people can understand and get and see its relevance. Really, really important. And so, I call them ready reckoners. When you have sort of a volume times a unit economics equals an outcome. Well, everyone can understand volume. I'll do less of it. Everyone can understand a unit economic. I'll get the best one that delivers the best unit economics, and then the outcome is this. And you can get aligned around that. So I think if for example, you can understand your emissions that way across a variety of emission generation items, then you can build your reporting around that, and then you can get the whole company aligned. And you can change behaviors. So that's the way we're approaching it. I think it is going to be heavily regulated. Any finance people in the room that know we've been audited for all of our careers, so we know what it's like to be audited. I'm not sure most corporates fully understand how stringent the audit requirements are going to be around ESG. It's going to be a big wake-up call, but an important one as well, though.
I don't know if you have anything to add there, Rob, because I know you've spoken about this before, too.
Well, so one of the reasons I look so haggard is we've just closed our sustainability report and put that out. But when it comes to the ratings, then you're obviously unpacking a lot of that data, reformatting it, different requirements and all the rest of it. So I find a lot of the time I'm stuck in this horrific kind of alphabet soup of stuff, and it's a nightmare. And I often ask myself, how many investors are really getting what they want to have from some of the data points that we're being asked to disclose? Is it really driving your investment decision? So there's a couple of things that I try and think about. So one is try and get our materiality process as solid as we can make it. So we really think about all the stakeholders and what do you want to have from us? What really matters to you? And then the second thing is to try and think about, and again, a little bit as Stephen's talking about, is how do you communicate those things? So we try and work really hard to make the information as accessible as possible, trying to share the most material items so that hopefully people who've got an interest in the company can quickly see how we're actually performing.
Yeah, and I want to ask you, because you mentioned materiality process again, and I want to ask you a little bit about the developments around double materiality and how you see that maybe differing from, the materiality processes that are maybe more typically used.
I think it goes hand in hand with what Stephen said around the assurance piece as well. So you're trying to stress test and have the most robust, information flow about how the company is performing. So in that space, you're trying to improve the quality as high as it possibly can be, and using that kind of a framework is exactly the sort of thing that can do that. And I think hand in hand with assurance, then hopefully anyone who's reading the material that you're producing, it's going to be as robust as your financial numbers, and you'll give value.
Yeah. And I want to come to you now, Freddie, and kind of bring us to this broad conversation on standards. You mentioned the alphabet soup, and I think that's a phrase that a lot of us have heard, the alphabet soup of ESG standards. So what do you think about recent efforts to develop some slightly more global standardized standards on ESG?
I think that anything that can allow a very clear set of rules of where we're playing and how we can win. I think across companies, that to me, at any point in the globe, is something that we should all admire and we should all try and seek for. I think actually, to just pick up on something Paul said earlier around the importance of really putting sustainability and ESG into a space where everyone can get on board with it and understand it, simplify it, speak in plain English, and cut out the alphabet soup. It's something we try and do at Oritain. I'm constantly being told that I use too many alphabets, but it's trying to ensure that when you use something like, for example, on a supply chain, you talk about something in forensic science which is simple and easy to understand, and in data that you can then stand behind. And I think the ability to be able to do that and justify why we're making these investments in the short term for long-term gains, despite the economic pressures, is where we need to be landing.
And can I just ask you a follow-up question there? Because we have talked about making it more accessible and the need to make it more tangible. Yeah. Do you have any best practices on instances where maybe ESG language has become more accessible to your everyday reader?
Sure. I mean, I think actually I'd reference one of the clients we work with, Primark. We all know them. We all know who they are. Actually, what they've done is, as I mentioned earlier, about ESG being a positive case, is that they've actually developed a program for some of their Supima cotton, which is a higher quality of cotton, to be able to say to people, this isn't just something we have to do. This is a really positive way where they've worked with us to say, we know where this cotton comes from, so we know that then it's a positive piece of work that can demystify the alphabet soup, as we discussed, clearly show to their end user, their consumer, a positive piece of work that allows ESG to be known accordingly. So I think that's a really tangible proof point that says ESG can have really positive things for the end user, whether it be an investor, a regulator, or a consumer.
And Paul, do you have any thoughts on how sort of technology might help with these standards, with these?
Yep. Look, I mean, I was catching up with Anna a little bit on this, how many different reporting standards she has to juggle and how many different data points, and obviously, our technology can help facilitate some of the mapping, so the different outputs and the work. But coming back to something I think Stephen you said about we need the regulators to simplify, and does everybody need all these data points? I mean, I live a little bit in today. It is what it is. How do we make that easier? How do we make that most efficient? I think over time, with some more of the standards coming along with the ISSB and with the ESRSs here in Europe, and maybe some more guidance from the SEC, particularly in the US, that is going to drive to maybe there is only one or two, and then we can get to those simplifications. Yeah. But in the interim, just like anything, progress is not always overnight. And in the meantime, how do we deal with what we have today? Absolutely, technology is really the only way, because you can't now, especially now, one, finding talent is difficult, and two, hiring talent. We're a technology company. 80% of our costs are human capital, and we invest a tremendous amount in them. And they tell us this is important to us, especially the next generation, the Gen Z, even the millennials. That is where our talent is coming from, and if we don't do this, if we are not committed to this, then we're not going to attract the best and brightest, and innovation is the only way to survive in tech.
Yeah.
And maybe I can just share a little bit about what we've done to make our reporting more accessible, right? We have a number of stakeholders, including those current employees and future employees that you want to attract, retain, and motivate, right? But you also have investors, NGOs, consumers, customers, a full value chain of, myriads, and the regulators now, and et cetera. So what we've done is we've taken traditionally what's been a sustainability report, and we've pivoted to an ESG summary. We know we can't get everything into one report, if you will. So that ESG summary is meant as an entrance point to various consumers and can serve, for that purpose. And then from there we have, it's online, so it's fully digital, and you can navigate. You actually have a report builder where you could build your own kind of section and content of what you want. And then we link to ESG topics A to Z. So you could think about that as an encyclopedia of over 50 different topics on sustainability that people are interested about, of what we as PepsiCo are doing. And on there we have things like our strategy, our approach to various topics, our policies of what guides us as a company. And then we have performance metrics and year-over-year timestamp data that has been verified and audited by a third party, whether it be Apex or in some cases KPMG or others. So ultimately what we're doing is making sure that we're transparent, taking a stakeholder-centric approach and trying to make sure that it's accessible. Again, with that digital, it's a very good, useful way to make sure that we can map between the different parts of our sustainability reporting agenda, and also that maps to, the alphabet soups, because we do report to TCFD against SASB and those various. So against our green bond, we have a $1.25 billion green bond that we issued last year, and also do reporting on that. So again, that's all that, so much criteria, but ultimately it's how do you get that out to the stakeholder, and that's our stakeholder-centric model.
I'm sorry.
So
no,
quick one on that. So I previously worked in a company that also had a very fancy platform that allowed the user to find the stuff that they were interested in. I think just building a bit on what Paul was saying there is we've got a battle to get talent in, plus there's a cost barrier at the moment in terms of technology to have that very fancy interface, which is the optimal position. So I think that's a challenge for some smaller companies in terms of how do you find a digital solution that can have all of the cool functionality that Anna's chatting about there.
I see you.
I was just going to say, one of the things we're really excited about being the global provider for XBRL and machine-readable data is some of the international standards looking to digitize this and make it machine-readable. It really is not that approachable for individual questions, but if you can make it machine-readable and you think about what is going on with the explosion of artificial intelligence and machine learning, everybody wants a little bit different cut of information. So we're really excited about what's going on with e-fragging and finalizing some of the digital formats so that it can be more accessible and reused in different ways, so it isn't just that one-to-one relationship.
Yeah. I have a few more questions, and I'd love to pick up on a few of the points you mentioned, but I'm conscious of time, so I want to see if anybody... I see there are no questions on Slido, but I want to see if anybody in the room has... Yes. Any questions, basically? And then I think there's somebody else here.
Thank you. So with regard to the breaks that, say, the small businesses get within the supply chain, for example, preferential payment terms, if they're moving in the right direction, would you say that only creates sort of an echo chamber of people working towards sustainability, and those SMEs that aren't able to get left behind? And should the focus be on creating benefits and breaks for those SMEs, small and medium-sized enterprises that aren't able to join the journey?
Is that directed at me? Because
Well,
one of the things that we've done is we realize that there's a whole suite of tools that need to be provided to suppliers to bring them along. So we have an education platform. We have something called Supply Chain College for our suppliers. We also have invested in Renew and try to bring the tools for different suppliers to change to renewable energy and drive transition to PPAs and such. So it's one tool in the toolbox. I was specifically talking about that because that's more of some of the work that my team has done. Some of the other programs that we're doing around suppliers are really focused from some other of my colleagues and peers within the company. So just, I guess, don't want to misrepresent, but we do understand that there is a lot of work to be done, including, we have teams that go out directly to the farms to work on that transition with our farmers and throughout our full value chain, not just the supplier incentive that I mentioned.
I think there was one more question over here.
Thank you very much for the discussion. I had a question regarding the link between improved ESG metrics and financial returns, in the sense that you mentioned that, I think you in particular mentioned that that works best when that's part of the core strategy of a company, where sustainability is part of that core strategy. Do you think that's maybe harder for some companies who have been built or where the core business model was designed at the time where the priorities were different? And maybe for that kind of companies, or just generally companies who are not necessarily taking that on board to the same extent, are you also concerned about selective disclosure of, I think an example was the premium cotton. What about the rest of the cotton, for example? What are the practices in some areas of practice of companies that they're maybe a bit less comfortable about, or less aligned with these ESG metrics?
I don't know.
Yeah, do you want to pick up that last point, and then I'll direct to others, I think, for the first point. To answer your question directly, I think what we find when companies come to us is that they are looking for a multi-year relationship, because they understand that their supply chains are complicated. That's been made even more profound by things like we saw Suez a couple of years ago, COVID as well. So we only work with companies that specifically understand that, and they want to make positive change. And I think it comes back to my point earlier that says, they understand the science, they understand the data, and when we brief them on it, they say, okay, we get it. What we really want to understand is, if we've got problems, let's fix the problem rather than just hope it all goes away. And I think, I use the cotton example because it is something that it is quite sort of sensitive, and it's quite an important piece, but I think companies really do want to do the right thing. I think they're a little bit frightened about saying the wrong thing, and I think that's something that we should all encourage, as we've mentioned on this panel today. ESG is something that can be positive, and I think that's what Oritain really sort of strives to do with our clients. But I think you had a first question that I think is probably more to others on that one.
I'll have a go at that one, and it is a huge challenge. I mean, essentially, what I find is difficult is what I call operationalizing ESG and making it a way of life within a corporate. Because let's face it, most people are given sort of 8-10 hours today, and they work very hard. And for years, they've been told, do this and do this very well. And now they've been saying, do that and do something else as well. And that's hard. So it's going to be a difficult journey, actually, this one. So we shouldn't underestimate it. And I think that's why the more you can link it with your business goals, the better, because then the relevance sinks in.
We have time for one more question, right? And yeah.
Thank you so much. And thank you for a wonderful panel. Resonates a lot on so many dimensions. And actually, to continue on your answer to the previous question and linking to something that you and Anne and others mentioned earlier, what we're talking about requires quite a serious mental change, behavioral change. And we're talking about suppliers and everything. But Generation Z is slightly different. I mean, there was a research recently where young professionals, when still students, were asked how you're choosing your first job. And the statistics, I think that was primarily for continental Europe, showed that they were prepared to sacrifice up to 18% of the compensation if the company's values aligned with theirs. So they're ready to work for less money if they are infused and happy about the company values. May I ask, what is it that you do now? Do you go to the universities? How do you engage with this future generation that will come? And do you do anything in relation to ESG literacy or SDG literacy, slightly wider topic? Thank you.
I can say something quickly on that. So Aston Martin works with the Prince's Trust in the UK. That's a huge charity organisation helping some of the most deprived people, sort of 18 to 30. And we do a whole range of different interventions. And that's everything from interview prep to confidence building. We have confidence coaches through the Prince's Trust, through to helping people start their own businesses or get into employment. And we're also then trying to tie the linkage then between not just helping people generally, but then also feeding into the automotive sector and showcasing, careers days, open days, and so on, to say, there's a place for you, wherever you're coming from, you can find a job here. So that's some of the kind of stuff we do.
Great. Well, I'm seeing this overtime flash constantly in front of my eyes. So thank you all so much for being here. Thank you all for your time. This was an incredibly insightful conversation.